Alright guys, what's going on? Welcome back to the channel. My name is Leo, and in this video here we're going to be doing an analysis on Ford Motor Company. You definitely know this business. They've been around since early 1900s. First, I guess, mass-produced automobile. Make some pretty cool cars. Without further ado, let's jump right into it. Alright, so we got Ford loaded up here in our stock research tool. Let's do a comparison on the company metrics and determine where this company is and where it's been. Comparative PE ratio, we're down from our 5-year average, which is good. We have a 4 compared to 191. That's amazing. EPS increase over the trailing 12 months. We have a 4.49 compared to our average of 1.40. ROE is 46% compared to a 13%. That's a phenomenal upside. Profit margin, huge increase from 13% over our 3.8% here. Revenue at 136 billion, net income on 17 billion, free cash flow 9 billion compared to our 5-year average of 11.3. We're slightly down, but that's fine because on average we pay out 400 million in dividends at a 1.12% rate or yield, so they can cover the dividend just fine, but this free cash flow decrease is somewhat concerning. Return on invested capital 10% compared to 3.6%. Allman Z-score, we have it at 1.0. We want that over 3, folks. And Piotrowski score is 6. We want that between 7 to 9, ideally 8 or 9. But I'll take what I can get, and 6 is not looking too great. So overall, on this company metric snapshot here with Ford, it's a little bit of a mixed bag. It was starting off really good in the first half, and then the second half, not too great with this Allman Z-score and Piotrowski score. However, I will take that as a grain of salt because the return on invested capital is decent. The earnings per share is huge improvement, and return on equity. But the free cash flow being a decrease from the last 5 years, the last 5-year average, that's concerning. Let's jump into the financial valuations, get a little score sheet going, and seeing what this company is all about. So right now I'm grading this about a 4, and let's jump into the actual numerics of it to understand why it's graded as such. At a 5-year PE average ratio of 191, we want this to be under 22.5, folks. We don't want to overpay for their earnings. So 191 is not great. However, as we discussed earlier, the trailing 12 months is at 4.01. So who knows what the next 5 years is to come, but if this number can decrease substantially, that'd be phenomenal. Current ratio is 0.67. Terrible, folks. That's terrible. We want it to be over 1.5. What this indicates is that Ford has a lot more liabilities on hand than assets, and if things go south, they're not going to be able to cover all those liabilities. Return on equity average, it's 13%. We want this to be over 15%, folks. Our trailing 12 months has it, but our 5-year average isn't. We want that over 15, and we don't have that. EPS growth, phenomenal growth, 348% increase over the last 5 years. Debt to equity, under 50%. It's amazing. Share dilution, a slight dilution of shares over the last 5 years of 0.55%. 0.55%. That is, it's very, very, very minuscule. Ultimately, we want to see this number stay the same or decreasing, ideally decreasing. Net income growth, 135% increase, phenomenal. So we had a little slight error there, folks. I have to just quickly adjust something. Actually, the score is 3, not 4. Program wasn't reporting the free cash flow numbers correctly. However, it fixed that. So where we left off was increase in the 5-year net income growth, which is phenomenal. However, free cash flow growth has been decreasing, a negative 13% decrease over the last 5 years. It's not good. 5-year return on invested capital average is 3.6%. We want that over 10% or 10% or higher, as well as the 5-year revenue growth. We want that to be increasing, and it's at negative 1.69%. So Ford is losing money, folks. Free cash flow is going down, revenue growth is going down. It's tough. It's tough, but yeah, this is not looking too good for this company. The trailing 12 months numbers are good. However, guys, we need to see what the company's done in the past to see if they have the pedigree to kind of carry forward. Now, granted, the past is not the future. However, we can learn from it to understand where the company might be projecting to go. So now there's a whole uproar in these electric vehicles that are taking the market by storm, and all these EV companies are coming out of the woodworks. I believe Ford will eventually be a major player in that. However, time will tell. So let's jump into a price analysis and determine what is an applicable price to pay for Ford. If you're enjoying the video up until this point, make sure you hit the like button and the subscribe button. It helps out the channel a lot with the YouTube algorithm. Makes me feel warm and fuzzy inside. And we'll jump into this real quick. So, for those that are returning viewers, you know I'm going to make this as conservative as possible. For those who are new, I like to keep all my assumptions fairly conservative because I don't want to put anything astronomical out there, because I want to be wrong, but I want to be on the good side of wrong, where they do better than my assumptions. So that's why I'm going with a 0, 3, and 4 assumption. You know what? It might even make sense to go -1, to be honest, because they hit that there 0 and then maybe a 4 or 2% increase. Profit margin, we want to do, it's incredibly low. So how about we do 2, 2.5, and 3. Free cash flow margin, you know what? I can see them hitting, we'll go 6, 7, 8. Yeah, so I want to, it's 7, 4, ooh. See, I can see them hitting these numbers here, right? Like a 6, 7, 8. And price to free cash flow, I think I'm going to just keep it around this number as well. So I'll keep it at a 6, 7, and an 8. With the PE ratio being at 4.01, I might go a little bit slightly aggressive. Now, this is going to probably trigger to be a buy. Now, this is jumping it up. However, it's a huge decrease from our 5-year average. So I'm trying to play around with those numbers there. But yeah, these are the numbers I'm going to go with. Go with a 13% return rate to see what that might yield. And we have, oh, geez, if it actually populate 13%. Okay, interesting. So with negative revenue, guys, a negative 1% revenue over the next 10 years, we do hit the DCF calculation at $19. So that's currently going to strike it as a buy, pretty much across the board here for our conservative, moderate, and aggressive evaluations. Now, our aggressive number hit at 22.95. It's currently at 17, and our average calculation is at 16.35. So, folks, we're almost in that buy range for Ford, assuming, and this is assuming terrible revenue growth. This is assuming the revenue stays the same for the next 10 years. We lose revenue on one evaluation, or we grow at 2%, which in the last 1 year or so, it was a 7% increase. These are all things that could potentially happen, and these, in the conservative moderate categories, are both terrible, and it's almost hitting. We're almost in that range, folks. Now, would I go out personally and buy Ford at $17? Let's say everything hit. I'm going to probably stay away from it just because of these huge debt levels with this current ratio. I want that to be over 1.5. I like that they're generating a lot of financial leverage through equity within the business, but their debt levels scare me. That's the one thing that's going to be holding me back from getting into this company, because if things really do look terrible in the future, the debt's going to cripple them, and we don't want that. So, with that being said, this number here, I think it's pretty fair. I think it's pretty fair. It might be in this 16 range. It might be in this 15 range. I mean, if you believe this aggressive number here, it's a buy, right? We got 2 of the 3 at $19 and $33 here. If you can live with these debt levels, plus the decreasing free cash flow and revenue, yeah, I mean, I would say go for it. Now, keep in mind, folks, this is for entertainment purposes only. It's not financial advice, but you definitely have to do your own research. Now, this application that I have in front of me can be yours. It's going to be developed into its own app, and it helps me save so much time just to like go through so many companies within minutes to determine whether I should be looking at this further or not. If you're interested, drop a comment down below, as well as drop a comment of a company you would like to see evaluated as well. So, thoughts on Ford? The debt levels scare me. I don't think it's a buy currently until they figure those debt levels out. However, their EV vehicles that they're bringing onto the market excite me. So I have mixed feelings, but I'm gonna stay away from this one. And if it does creep down to a lower price and their debt levels are getting resolved, which I don't know. Let's see. You know what? Let's just look into their income and see what's going on. Let's actually just dive deep for just a quick second and see what's going on. Revenue. Right. Yeah, it's a decrease. Total liabilities. Long-term debt. Oh boy, that is a lot, guys. This is the 2021 numbers? Yeah, 2021 numbers. Okay. Total liabilities. Yeah, it's the debt levels. The debt might be the death. But those are my thoughts, guys. I appreciate you guys for watching. Let me know your thoughts on Ford. If you're invested, where you think this company's heading. But yeah, that's the video. Thank you so much. I'll see you in the next one.